What's up, everyone? With the bull run in full swing, a question that a lot of people are having is what is the exact best way to buy dips? And in the past 4 years that I've been in crypto, I have went through a lot of trial and error, lost literally $500,000 trying to learn this. And I believe so far I have found the best dip buying strategy. This will be applicable throughout the bull market. And the best part is, in the bear market, this also works as well for allowing you to short the rallies. Most importantly, this is very beginner friendly, and this is rooted in smart money trading, meaning what you are about to learn here is trading alongside the smart money, which means that as long as these institutional players and these whales are interested in driving the market higher, you are going to be buying right alongside them. So before we get into it, let's talk about like some of the most popular dip buying strategies. First of all, you have the SMA and EMA strategies that is popularized a lot for beginners by the trading gurus on YouTube. And then you have support resistance. You also have a Fibonacci retracement. Maybe you have the people that are coming from ICT, and you have the order blocks and fair value gaps. Now, there are also people that are into supply demand, and then possibly patterns as, retracements, and potentially even breakouts. Off the top of my head, these are probably what I can list as the most popular dip buying strategies. Now, I can go on and on. You can also say, you have the MACD RSI or whatever. Now, let me just preface this right away by saying that all of these strategies do work, but which one's going to be the best for a beginner and which one's going to be the best for following where the institutional money is placing their orders? The answer is going to be none of those, but this one word, which is order flow. Now, what you're about to learn in this video is how to buy dips based on order flow and how to trade based on order flow, how to read order flow. And order flow is simply just the trend of the market. And the reason why this has a fancy term is because this is what the institutional investors use. And one other thing that I do want to preface before we get right into this is that some of the things that I am going to talk about is going to be very reminiscent of supply and demand. And don't get me wrong, supply and demand works exceptionally well, but I'm going to teach you a better way to use supply and demand and the proper way to identify real institutional supply and demand, because let's be real here, we're not trying to be buying into retail demand or selling into retail supply, because first of all, the size is way smaller, and number two, 90% of retail traders are losers, and the majority of the winners tends to be the smart money whales or people that just know what they're doing. That's ideally what we want to be following, not retail. So diving right into it, we don't even have to go too far. Even if we just take a look at Bitcoin now. First of all, let's identify the proper way to read order flow. And you're going to want to do this, whatever you're learning in this video here, you're going to want to do this on at least the 4-hourly chart and above. Currently, you are investing in a bull run. Chances are you're buying dips so that you can hold for a decent amount of time so that you are able to achieve a 3, 5, 10, 20x return. You're not going to do that in a few days. You're not going to do that in a couple of weeks. This is stuff that takes multiple weeks and potentially even multiple months. Now, I know what you're going to say. Peanut went from basically nothing to $2 billion worth of market cap, giving like a 20,000% return or something in a very short amount of time. If you were to have put in $15, you would have gotten $1 million out of it. I know what you're thinking, but that is very much an outlier. For every peanut that exists in the world, there is 100,000 other traders, projects, or whatever that fails and just never gets talked about, because there is something called survivorship bias, where only the winners sort of live to tell the tale of the story. So don't fall for the bias. So going back into what I was about to explain, the way you read order flow is very simple. Now, let's take a look at this uptrend here. You can very, very clearly see that this is an uptrend, right? You have higher highs and higher lows. Overall, the trend is towards the upside. Now, let's have a deeper look into what actually goes on with the order flow during this entire uptrend. Now outside of really small anomalies, you can see that the majority of demand zones tend to hold throughout the duration of an uptrend. For example, once price comes into this demand zone here, you never break below it. And I know you're thinking oh, hey, this is just a retracement. Now here's where we get to the juicy part, because this is really clean, just institutional action. So if we just draw this block here, price comes into this block and finds a bottom. Now, yet again, we will have another demand zone. Price comes into it and does not violate it. Now, once price breaks out of this zone here, this entire zone becomes a demand zone. Now, obviously, price retraces a little bit back in here, but then now that price pumps away from it, now you turn into another demand zone. Now, in this case, price does not return back to the area, but still, you are forming more and more demand zones. Price retraces back in, but never breaks below it. And once price goes higher, this now becomes your next demand zone. Price comes in, but does not break below it. And boom, price continues onwards, and this becomes another, little zone. You could even say that it can come all the way up here. I wouldn't define it as such, I would say this is the demand zone. And then eventually, like, sure, you do get anomalies where you break below one of these demand zones, but overall, this is because this is a liquidity sweep within a trend, similar to what we got here, where we got a liquidity sweep instead of price holding the demand zone, basically, if you can take a look at that. Now, this is another setup that we are not going to be talking about in this video, but this is a method. Like, if you understand how to buy counterparty liquidity sweeps, you understand that the majority of moves in the trend actually follow a counterparty liquidity sweep. Again, not what we're going to talk about in this video. I'm just talking about like when price is going up aggressively, what is the best way to buy dips? Because if you notice, if you start waiting for, like, let's pull up an EMA, for example, the majority of people that use an EMA are going to be looking at, let's say the 50 EMA, right? Because that's what the majority of the trading gurus teach you. Now, if we just take a look at the EMA, for example, like ever since price broke out above here, you would not have had a chance to buy the EMA retracement all the way until 40K. So you missed the move all the way from 26K to 42K before you get a chance to buy in. And like, this is very much a lagging indicator. And then if you look at things like, Fibonacci retracements, well, guess what? You would very rarely have a chance to buy into any kind of retracement because price is just pumping straight up. And even if you were to look at breakout retrace, yeah, sure. Like if you're using that method right there, like breakout retrace, yeah, okay, that would have worked. But it's breakout retrace, while it seems to work, nobody is able to explain why it works. And the reason why it works is because you're trading alongside the order flow. Now, one thing to understand about order flow is that at every given point in the markets, there is always, buyers and sellers fighting a little tug of war. And in this case, the reason why order flow works so well is because any of the institutional buyers, I want you to think of these blocks that I'm drawing here as volume areas, meaning there was a lot of selling that happened here and there was a lot of buying, but all of this was concentrated within a little zone. This is known as a value area. You can also call this a consolidation. You can also call this a range. Whatever it is, it's up to you. But the moment price makes an aggressive move heading out of that zone, this now becomes a future area of reference for any traders, really, like both retail and institutional, that, okay, this was a price where, there seems to be a lot of trading going on. And if price were to return back to this area, then this would be a fair value to buy whatever the asset is around the zone. The keyword here is that, first of all, you want to see some kind of really aggressive move heading out of that zone. And number two, you want to make sure that, the order flow is actually bullish. This is not going to work so well if the order flow is bearish and you are looking to buy. For example, in this entire zone here, you can see the order flow is pretty bearish. And sure, like every time you try to buy the dip in one of these demand areas, you're just going to get blown right past. But in this case, the flip side is true, where every single bearish zone that you form is generally not going to get violated. Now, for example, once you form the zone here, price retraces into the zone, goes down. Again, here you have the zone, price comes into it, does not break above it, goes down. Now, over here, now this becomes your new zone, price comes into it, goes down. Like you can see, for the most part, like even if there are some, deviations, for example, deviation here, it is very much just for a counterparty liquidity sweep before that marks the top and price goes down. So this is what I mean when I say that this is something that is rooted in institutional trading. Again, price comes up, but does not violate the zone. Here, price comes up again, but as for the most part, right, it's reaching for another, supply zone. Eventually, prices come up again, but fails to break this, and boom, like this becomes your new zone, price doesn't come back into it. Over here, that's your zone, price comes up into it, goes down. Like I can go on and on and on and on, but for the most part, you can see this is just supply and demand at its finest. And so I think that tells you a lot as to how to buy dips. Now, coming back to Toshi, for example, I was actually inspired by this because this was an entry that was absolutely perfect. And the majority of traders would not have been able to see this. Just on the daily chart here, Toshi initially, like on this day right here, on Monday, or I believe it was Tuesday, there was an announcement by the team at Toshi that Toshi Tools was finally live, and that became a catalyst that led to Toshi pumping by that led to Toshi pumping by 30% within the same day. Now, in the very next day, you can see that this does not look like much on the daily chart, but the moment you go into a 4-hourly chart, you can see that's what I've been telling you about, right? That value area. That's an area where price was trading, where price was quote unquote finding fair value before price exploded out of the area, returns back to the area, and then boom, right? That becomes your zone for buying a dip. And This goes against all conventional wisdom of like, hey, you want to wait for your SMA, your EMA, you want to wait for at least a, 0.618 Fibonacci retracement, premium discount, whatever. Like all of this is just based on institutional supply and demand. Now, if you guys are interested in, learning more about supply and demand, like more in depth, I'm about to relaunch my free trading education group. And I know what you're thinking when you hear that, but don't worry, there's no BS, there's no fluff. I'm only providing value inside that group, and the goal, which is that by the time you finish going through the lessons taught in that group, you will be fully self-sufficient as a trader. You will get my exact step-by-step playbook, my exact system on how I trade the crypto markets, and all of this for absolutely free. The last time I did this was V1, and it happened last year. And I think the majority, I don't have the exact figures, but the majority of the students that went through it actually became profitable traders, and all for absolutely free. Now, if you're interested, you can sign up to the waitlist down in the description box below. But otherwise, let's get back into more order flow trading. So now that all you want to look for is, again, 4-hourly chart and above. You want to look for demand zones, essentially. So this becomes like your new zone of demand. Now, this is different from when we talk about, for example, the real, like just people that have been doing, supply and demand trading for a while. You're going to say like, hey, even though you're talking a lot about, supply and demand, you're not mentioning anything about, drop-based rallies or rally-based drops. Well, that's because this is a very different type of supply and demand, right? Right now, we're talking more about order flow rather than exact pinpoint, supply demand style patterns. If we were to get into the details on that note, then, this would become your drop, this your base, and that's your rally. So this is where the pump begins. Again, something a little bit different, not something that I'm covering in this video, but something I will be covering inside the free group. Supply demand, by the way, is one of the best ways for you to catch quote unquote bottoms, or like quote unquote catch the areas where like large moves begin. Just to give you an example, I think it was on, if you take a look at this picture that I'm sharing here, again, notice like you're able to catch the move. Like this is something that I called in Discord, by the way, over here. Essentially, you're able to catch moves right before like they begin their explosive movement. Now, this was during the elections, but again, totally different concept from what we're talking about right now. Just coming back to order flow for a moment, I just want to show one last thing for you that will help you cement the concept of order flow in your head a bit more. So when you are in bullish order flow, highs are attacked, lows are protected, vice versa for bearish order flow. Now, in the context of a bull market, we're going to talk about, now let me just show you how that looks like. Essentially, this is just a fancy term to explain that when you are bullish, the highs are constantly taken out and attacked, and the lows are constantly protected. Now, where are these lows coming into generally? Well, guess what? They're coming into areas of order flow, right? This is all based in institutional trading. So this is what I want you to pay attention to. Now you can say that this will line up with your Fibonacci, for example. Now, just to go back to when the pump started, we can see that price actually retraced pretty deeply into a Fib retracement. And yet again, if we say go from here to here, now, this is one of those moments where price does not. Now, you can say that, hey, you can use your Fibonacci retracement to do this, but price isn't always going to do this type of clean retracement every single time. So what you really want to do is to follow the order flow. For example, over here, if you draw a Fib here, price would have retraced pretty deeply, but from here to here, price actually does not even come close to coming into the golden pocket. And yet again, from here to here, like, yeah, sure. Price would have retraced into some kind of golden pocket, 0.5, as you can see right there. But are you going to rely on something like this that is not rooted? Like if you use Fibonacci retracements just by itself or premium discount just by itself without adding any sort of confluence, this is where you get into trouble. So this is a technique that is especially useful when you're in the middle of a bull market and stuff is pumping just absolutely bonkers. For example, if we take a look at WIF has been going absolutely wild the last few days. And like if you're not using order flow trading, like you would have missed out on all the moves, because guess what? If you're waiting for some kind of Fibonacci retracement, heck, I'm even going to put on the EMA again, because that seems to be the most popular way of buying the dip, or at least for most beginners. So if we put on the EMA, yeah, sure, you would have gotten a chance to buy it here. But at every single point since $2, it has doubled in the last couple of days, more than doubled in the last couple of days, actually. Like you would have missed out on all of this. And don't get me wrong, you can use this on the lower timeframes as well. But again, for most people, what I would recommend is just to stick to the 4-hourly chart and above, because this is where the signals are the most clear. And you're not trying to buy into something just to hold for a couple of days anyways. You're buying into something to hopefully go from $1.9 to $5. Now, this happened really quickly, and there are going to be many instances in a bull run where you get a 2x to 3x really quickly. But again, is 2x to 3x something that you're looking for? If it is, sure, go ahead and use the lower time frames. But if you're looking for anything more than that, this, like the higher time frames, 4-hourly charts and above, my preference is going to be the daily chart. This is going to be where your bread and butter lies. Now, again, because you're taking a bet based on order flow, it's super simple to just set your stop loss underneath, whatever zone that you're looking at, because this is just clear invalidation. Your idea is that this zone should hold. If it doesn't hold, then boom, your idea is invalidated. If you want a quick little video on exactly how to set your stop loss with a proven thought process that isn't rooted in retail BS, I have already made a video about that. I'm going to link it right after the end of this video, so feel free to check it out.